is planning to set up a business on the 1st of the 7th, 2016 and has made the following forecast for the first 6 months of trading. So there you can see the sales budget, you've got your sales units and then you've got your sales revenues for every month from July through to December. So note 1, each product unit requires 3 kgs of material X, which costs €4 per kg. Note 2, stocks of finished goods are maintained at 60% of the following month's sales requirement. Note 3, stocks of raw materials sufficient for 20% of the following month's requirements in kgs are held at the end of each month. Note 4, the cash collection pattern from sales is expected to be cash customers. 30% of sales revenue will be for immediate cash, and credit customers. 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. Note 5, 1 month's credit is received from suppliers. Note 6, expenses of the business will be settled as follows. So expected costs, wages, €10,000 plus 5% of sales revenue per month payable as incurred. Variable overheads, €4 per unit payable as incurred. Fixed overheads, including depreciation, 28,000 per month payable as incurred. Capital costs, equipment will be purchased on the 1st of July costing €60,000, which will have a useful life of 5 years. To finance this purchase, a loan of €48,000 will be secured at 10% per annum. This loan and interest will be repaid over 4 years. Monthly capital and interest payments will commence in August. So required, Part A, prepare a production budget for the 4 months July to October 2016. Now it's very important that you see there it's only 4 months July to October. Part B, prepare a raw materials purchases budget in units and in euros for the 4 months July to October 2016. C, prepare a cash budget for the 4 months July to October 2016. D, prepare a budgeted trading and profit and loss account for the 4 months ending 31st of the 10th, 2016, if the budgeted cost of a unit of finished goods is €20. E. Part 1. What recommendations would you make to Irwin Limited based on the budgets you have prepared? And Part 2. Outline the factors which Irwin Limited should take into account when estimating future sales figures. So Part A, prepare a production budget for the 4 months July to October 2016. Alright, so the information that we're going to look at now is going to tell us how many units do we have to produce for the 4 months July to October. So we've got the sales budget here, the sales that they are anticipating to sell from July through to December. Now note 2 here says stocks of finished goods are maintained at 60% of the following month's sales requirements. So we're going to have closing stock, okay, of 60% of the following month's sales requirements. So they're telling us that we need to have that. Okay, so looking at the production budget, we're going to put the sales figures across the way. Okay, so we'll have 9,750 here, 11,000 here, 12 here, and 12,500 here, which is all coming from that. Why are we thinking about November? We have to think about November sales in units, as we are told the stocks of finished goods are maintained at 60% of the following month's sales requirements. So November's 12,500 units, we need to multiply that by 60% to know what our closing stock needs to be in October. So July, we have just 9,000 units there. There is no opening stock. August, we've 9,750. Multiply that by 60% is our closing stock that we need then in July, because this is 60% of August's sales. And then you continue to do the exact same thing across the board there. So you write out all of the sales and you multiply them by 60%, and that is going to be the closing stock of the previous month. Now the closing stock of a previous month is the opening stock of the following month. So if we look here, August 9750 multiplied by 60% is €5,850, which is July's closing stock. July's closing stock is August's opening stock. We take away the opening stock because we do not need to produce the opening stock. The opening stock is already in existence there. It already exists. We do not have to produce that again. So overall, required for production then is 14,850 for July. In August, 10,500 for August. September is 11,600. October is 12,300 and November is 12,680. Now, where did we get this 7680? Well, that was 60% of December. So 12,800 multiplied by 60% is your 7680. Now, we might need to know November's figures later on, and you'll see that we actually will. So no harm in doing November as well. So part B, prepare a raw materials purchases budget in units and in euros for the 4 months July to October 2016. So we want to know how many kgs of materials do we need to purchase in order to satisfy our production that we worked out in part A, and we'll also need to know how much is that going to cost us as well. So the information from the question that we're going to look at is each product unit requires 3 kgs of material X, which costs €4 per kg, and note 3, stocks of raw materials sufficient for 20% of the following month's requirements in kgs are held at the end of each month. Okay, so bringing that information into part B, we have our required number of units here, which we worked out in part A. We are going to multiply that by 3 kilograms that we got from note 1. So each unit requires 3 kgs of material X. Okay, and then we're told stocks of raw materials sufficient for 20% of the following month's requirements in kgs are held at the end of each month. Okay, so what we have to do is we have to find 20% of the following month and put it into the closing stock of the previous month. So in August, we need 31,500 kgs, multiply that by 20%, and that is what they want to have in July as closing stock. July's closing stock is going to be August's opening stock. So that's your 20% there of your 31,500. We take away this opening stock because we do not need to purchase that in August, because imagine that it is already sitting in the warehouse. You do not need to purchase that. So you do the same thing across the board. 34,800 multiplied by 20% is equal to 6,960 kgs, which is going to be our closing stock in August, and that is going to be our opening stock in September. October's requirements there, 36,900 kgs multiplied by 20% is 7,380 kilograms, which needs to be the closing stock there for September. That is going to be the opening stock in October, so minus 7,380 there. Then we have November, 38,040 kgs multiplied by 20% is 7,608 kilos. Now, what we need to do then is just tot everything up and find the kilos going across the way. So July, August, September, October. Alright, so 50,850 kgs are required in July, 32,160 kgs are required in August, 35,220 kgs are required in September, 37,128 kgs are required in October. Then we need to multiply them by the cost per kg, so multiply by 4 across the board there, and then the cost of raw materials are 203,400 in July, 128,640 in August, 140,880 in September, and 148,512 in October. So that is part 2 done, the raw materials purchases budget. Now part C, prepare a cash budget for the 4 months July to October 2016. So you can see now the first two parts, part A and part B, were similar to your production budgets, your full questions on production budgets. But now part C is like our cash budget questions. However, they're a little bit different because the full cash budget questions you would have to do 6 months, but here they are asking us to just do 4 months from July to October 2016. So looking first of all at the sales revenue here, and then we want to look and see about anything about receipts. Okay, so how is cash going to come in to this business, Irwin Limited? So similar to the cash budgets that we've done before, we'll take a read of the question and see how the business is going to receive the cash. So it gets cash customers, 30% of sales revenue will be for immediate cash. It doesn't say anything about receipt or giving a discount here. Credit customers, 70% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. So credit customers are 70%. So that's going to be split, 50-50 split between 2 months. So therefore the 70 is split into 35 and 35. So 270,000 euro multiplied by 30% is 81,000 euro received in July. Then 270,000 multiplied by 35% is equal to 94,500, which is going to be received in August and September. August's sales revenue, 292,500. 30% of that is going to be received in August. So 292,500 multiplied by 30%, 87,750. 292,500 multiplied by 30% is going to be received in both September and October. September's 330,000 multiplied by 30% is 99,000 euro. 330,000 multiplied by 35% is 115,500. October's 360,000 multiplied by 30% is 108,000 euro. When we tot all of those up, we get those total receipts there. So that's all of the receipts done. Moving on then to note 5, it says 1 month's credit is received from suppliers. So we aren't told the purchases here. We had to do a raw materials purchases budget. So remember we did this in part B. We have got the cost of the raw materials. So our creditors will give us 1 month credit. So July's purchases, we're going to pay for them in August. So 203,400 is going to be paid in August. August's purchases, 128,640, is going to be paid for in September. And September's purchases of 140,880 is going to be paid for in October. So that will be the purchases there. Now, moving on then to note 6, it says expected costs. Wages, 10,000 euro plus 5% of sales revenue per month payable as incurred. Okay, so we have to look at the sales revenue in order to get our answers here. So for July, if you put into your calculator 270,000 euro multiplied by 5% plus 10,000 euro is equal to 23,500. August, you put 292,500 multiplied by 5% into your calculator and then add 10,000 euro, you're going to get 24,625 euro. For September, if you put 330,000 euro multiplied by 5% into your calculator and then add 10,000 euro, you're going to get 26,500 euro. And October, you put in 360,000 euro multiplied by 5% and then add 10,000 euro, you're going to get 28,000 euro into your wages in October. So that's the wages. Then it says variable overheads, €4 per unit payable as incurred. Now, the payable as incurred, we are going to multiply €4 per unit by the number of units that are produced in each month, which we worked out in part A. So, 14,850 units for July multiplied by €4 is 59,400. August 10,500 multiplied by €4 is 42,000. September's 11,600 multiplied by €4 per unit is €46,400. October's 12,300 multiplied by €4 per unit is 49,200. So that is your variable overheads. Then it says fixed overheads including depreciation, €28,000 per month payable as incurred. Now, hopefully you'll remember from the other cash budget questions, you should know now that depreciation is not a cash item. And if you know your cash flow statements, you'll know that depreciation is not a cash flow item as well, because we learn an awful lot about that there. So what we need to do is take the depreciation out from that €28,000 fixed overheads figure. So how do we find out how much the depreciation is per month? Well, if we look down at the capital costs, it's going to tell us about the fixed asset here. So equipment will be purchased on the 1st of July costing €60,000, which will have a useful life of 5 years. So €60,000 divided by 60 months is €1,000 per month depreciation. So therefore your fixed overheads are going to be 28 minus 1,000, which is 27,000 per month. Then we're going to actually enter in the equipment that we bought. So the 60,000 is going to go in there. So it was bought in July. So nothing in any of the other months. To finance this purchase, a loan of €48,000 will be secured at 10% per annum. This loan and interest will be repaid over 4 years. Monthly capital and interest payments will commence in August. Okay, so let's think about this. Monthly capital and interest payments will commence in August. So how much will the monthly capital payments be? So a loan of 48 is going to be secured. So 48,000, okay, is going to be repaid then over 4 years. So 4 years is 48 months. So that is going to be loan installments €1,000 each month, which are going to commence in August. So nothing is going to be, no cash paid out in July, but August, September, October, we have 1,000 in each of those months. Then looking at the interest. So the loan of €48,000 would be secured at 10%. So that is €4,008 per year. Okay. So when we divide that by 12, okay, we are going to get €400 per month, and that is also commencing in August. So they are all of your payments. What you have to do now is tot all of those up, as you can see there. Then we're going to work out the net cash. So net cash is our total receipts minus our total payments. So you'll see there the first couple of months we have negative, we have deficits there. So July minus 88,900, August we have minus 116,175. September we have 65,935, and October we have 79,395. Now, we got a bank loan in July for €48,000. There was no bank loan any other month. There is no opening balance in July, but the closing balance is minus 88,900 plus 48,000, which is minus 40,900. The closing balance in July is my opening balance in August. So my closing balance in August is going to be minus 116,175 minus 40,900, which is minus 157,075. That is my closing balance in August. That is going to also be my opening balance in September. So 65,935 minus 157,075 is equal to minus 91,140. That closing cash balance is going to be my opening cash balance then in October. So 79,395 minus 91,140 is equal to minus 11,745 euro. So that is the cash budget done. So that is part C of this question. Part D asks us to prepare a budgeted trading profit and loss account for the 4 months ending 31st of the 10th, 2016, if the budgeted cost of a unit of finished goods is €20. So this is similar to the one that we would do in our cash budget, our full cash budget questions. So remember, you're only asked to do it for the 4 months, okay? So the 4 months ending 31st of the 10th, 2016. Okay, sorry, that should say 4, it should not say 6, but we've got the date right there. So sorry, 4 months. So sales, 270,000 plus 292,500 plus 3300 plus 360, so 1252,500 is your sales there. Then, less cost of sales. So we've no opening stock, but we do have purchases. So our purchases, 621,432, and that was from your raw materials purchases budget for the 4 months, July, August, September and October. So when you add the 4 figures up, you get 621,432. Then less closing stock. Now, we have to account for the finished goods and the raw materials closing stock, because we have closing stock, because we have a couple more months at the end here and we have closing stock that we had to calculate in the question. So finished goods, 7,500 units by €20. We were told about that €20 in the question when it asked us to do this budget trading profit and loss, plus our raw materials closing stock 7608. So look back at your part B and you'll find that 7608. Multiply that by €4 and that is altogether €180,000, €432. And that is equal to €441,000 there, leaving a gross profit of €811,500. Then we're going to less our expenses. So our expenses, first of all, we have our wages. So our wages, 23,500 plus 24,625 plus 26,500 and 28,000, €102,625. Then we'll add up the 4 months of our variable overheads. We get 197,000. Then we put in our fixed overheads, 27,000 by 4 months, 108,000. And our depreciation, 1,000 by 4 months is 4,000. Now we're putting depreciation in because in our trading profit and loss, we can put in non-cash items here, so non-cash expenses or revenues. So we want to look out for depreciation, discount received or discount allowed. They can all go in here as well. Then we less the interest, 400 multiplied by 4 months. We worked that out earlier on as well, 1,200, leaving us with a net profit of €398,675. So that is the budgeted profit and loss of Erwin Limited for the 4 months, 4 months, ended 31st of the 10th, 2016. Now, last part, part E. So note 1, what recommendations would you make to Erwin Limited based on the budgets you have prepared? And part 2, outline the factors which Erwin Limited should take into account when estimating future sales figures. So part 1, what recommendations would you make based on the budgets that you have prepared? So reduce the requirement for closing stock of finished goods, particularly in earlier months, to reduce the cost of production in those months. So if you ask for less closing stock, it's going to cost you less to produce them, especially in those earlier months. Negotiate a lower price than the €4 per kg from suppliers when buying raw materials, and this will reduce cash expenditure. Encourage debtors to pay earlier by offering discounts for earlier payment or reduce the period of credit allowed from 2 months to 1 month, which will increase receipts. Postpone the purchase of equipment in July and instead lease the equipment. This will reduce the deficit in July by €12,000 and the interest and the loan repayments €1,400 thereafter. Now, part 2. Outline the factors which Irwin Limited should take into account when estimating future sales figures. So number 1, market research and trends or opinion of sales reps may be a reliable indicator of potential sales. Number 2, what is the price to be charged for the product or service? Number 3, is the level of competition in the marketplace intense or not? And number 4, is the economy